I don't know, I think all of you have been at the sessions today and this morning at the high-level panel. I remember the Mr. Edward Klaassen from EIB saying that they were looking into guarantees as one of the potential solutions to help scale up the market further. And I'm very happy that I'm sitting here with some people who have actually been doing exactly that for the past years. We're going to see how guarantees can help unlock finance. And I'm here with, and I'll go from left to right. I'm here with, first of all, Patrick Mwangi, who is the East Africa Regional Manager for Camco. There is Eric Naivasha, Head of Sustainable Finance at KBC Group. We've got Ojuru Adeniji, who's the Vice President for Origination Structuring at InfraCredit. There is Ajibola Abiodun, who works with Okra Solar as the Project Finance Lead. And finally, there's Toby Fadesere from the Shell Foundation, the Investment Manager for Western Africa. And it's my pleasure to let them introduce themselves to you first. And what we're going to try today is to have a real discussion here on stage. So I hope that you are ready to hear what the panelists have to say. Please.
Okay. Thanks for that. As I've been introduced, I'm Patrick. I'm the East Africa Regional Manager working at Camco. And specifically, I look after the REP2 fund. It's a debt fund that looks after financing renewable energy projects within sub-Saharan Africa. As my title says, I look after East Africa, so everything from Djibouti at the north up until DRC at the bottom. We cover all those regions, all the renewable energy segments, apart from biomass and geothermal.
Thank you, good evening, and nice to be here. My name is Eric Naivasha, the Group Head of Sustainable Finance at KCB, the largest bank in Kenya, presence in 7 countries. I'm in charge of deploying capital into green assets for the bank, specifically in renewable energy across the 7 markets that we operate. Thank you.
Okay, the mic is working now. Hi everyone, so my name is Ojuru Adeniji and I cover the green growth sectors at InfraCredit and digital infrastructure. At InfraCredit, we provide local currency guarantees to infrastructure projects cutting across different sectors, but my portfolio focuses mainly on renewable energy. Thank you.
All right, I think this is working as well. Hi everyone, good afternoon. My name is Ajibola Abiodun, and I lead the project finance team at Okra, working at the sales side of things, working with the likes of InfraCredit on guaranteeing instruments. In terms of what we do at Okra, Okra Solar is one of the leading mesh grid technology provider, and how that works is it's a decentralized solution where the energy assets are installed at productive hubs, productive users, and the excess energy from those productive users are then shared to nearby households, thereby forming a cluster, and each clusters are then, connected to each other, which helps us to reduce the cost of the connection. So it's a pleasure to be here and looking forward to the conversation. Thank you.
Hello. Good afternoon, everyone. My name is Tobiloba Fadesere, representing Shell Foundation and FCDO. At Shell Foundation, it's an impact-focused foundation with a focus on ensuring that the economic outcomes of 3 customer groups, that is micro-enterprises, smallholder farmers, and transporters, improve while also lowering emissions. So typically, we operate across Africa and Southeast Asia, and we deploy all forms of capital, grant, technical assistance, debt, and we invest in equity through fund of funds. It's a pleasure to be here.
Thank you. Thank you all. So what we're trying to do today is to talk about guarantees a bit on the high level, theoretic level, but really also dive into some real life cases and examples. Because I'm very happy that everyone here on the panel can talk from experience when we talk about the impact and the catalytic effects of guarantees. But maybe to set the scene first, I would like to ask Eric if you could take a shot and help us to understand what the role is that guarantees can play in general.
Yeah, thanks. I think the first point to that question is that guarantees don't eliminate the underlying risks of projects. A bad project will remain a bad project whether we have guarantees or not. That's the first point. But then, what they help to do, because here we are de-risking good projects, we are not de-risking bad projects, at least from the banking perspective, is that we try to shift or slice the risk so that we can make those good projects that have some underlying risks attract private capital. I think that's the context in which we want to discuss guarantees. And from where we sit in the banking sector, there are a number of risks that we see that requires de-risking through certain instruments, guarantee instruments. The first one is the currency risk. I think that is what we have seen, because most projects that we finance, developers are looking for a dollar-denominated kind of financing, but they earn local currency in their power sales. And what we have seen over the years is a 20% depreciation in the local currency against the dollar, for example, if it was dollar denominated, will wipe out your internal rate of return. Just a 20% depreciation. And therefore, there is a case for guarantee there in currency volatility. The other one that we have seen is on the off-taker risk, because we have risk of off-takers. We have CNI projects who can default. In Kenya, for example, we have a history of KPLC delaying payments significantly. For mini-grids, we have seen the income levels of communities around mini-grids and lack of anchor loads in those mini-grids provided by the communities. So there are those off-taker risks, and there is a case for guarantee in that aspect. There are other risks of track records that we can talk about. There are other market risks that we can talk about, including policy risks, tariffs, regulatory risks, and there are many examples in Kenya where policy shifts have actually made projects more riskier. So in all those cases I've mentioned, we have cases for guarantee in all those cases. So I think thought I would say that to set the context in which we wanted to discuss. Thank you.
Yes, thank you very much. I don't know, Patrick, do you see any additional risks besides the ones that Eric has mentioned, like the foreign exchange, the currency risk, off-taker risks, track record? Anything that you see coming by at Camco?
From an East Africa perspective, at least, I can confidently say that the binding constraints are similar. We see there's a structural FX mismatch generally, with revenues being in local currency, particularly for the DRE markets, and then the capital is being in hard currency, so dollar or euros. So that's a key one that needs to be first and foremost addressed, at least in the DRE markets. And then obviously there's a payment / off-taker risk. So the instances whereby you need to reduce the perceived risk on any payment delays that may come about. This gives comfort in terms of the end perceived risk we face when we put projects for approval in our investment committees. So naturally, if you try and address some of these factors using guarantees, we inevitably end up reducing the cost of capital for projects. And in that case, we can be able to do more projects. So that answers the scalability aspect. So just by way of general rule of thumb, the cost of capital for projects that are developed in Africa about 2 to 3 times what we have in the more developed markets, and this is primarily because of the risks I think that Eric has mentioned. So the FX risk, the payment delays, and the thin track records that we see in the market. So by and large, I'm in agreement with what he's saying and what he's seeing in the market, and that makes sense because we're looking at the same markets.
Yeah, no, thank you, and I'll definitely give you the opportunity to talk about more about what you and your organizations are actually doing about that. But indeed, to go and dive into those cases, maybe Ojuru, you could let us know how you at InfraCredit have, what you have actually been doing to use the guarantees and reduce risk, be it perceived or actual, and take us along. And then I would like to ask, at the same time, because you've worked on the project together, to fill in and step in where needed.
Okay. I mean, at InfraCredit, we have a climate finance blended facility that was seeded with £10 million from the UK FCDO and British International Investment. Now that helps us because that provides first loss capital to different projects. And then you have the senior debt that is layered on top of all of that. I mean, if you look at the mini-grid space alone, it's not a sector that an infrastructure financier like ourselves would essentially go into. But the first loss capital gave us comfort. So yes, there's a trade-off between the perceived risk and the real risk that you see, right? And when you've understood the market very well and you're able to dissect what that risk is, then it helps you better to structure the transaction. The other thing, again, is the climate finance blended facility. The portion that is seeded in foreign currency, that foreign currency is used to procure the equipment. So most of the equipment that is required for mini-grid projects, a lot of it is imported. So that portion stays in the currency it comes in, and then it enables the developer, it goes directly to the OEM for it to be procured. So it's the same thing we had on the First Electric example. That's a mesh grid project that InfraCredit, structured. Okra Solar was the OEM on that particular project, and the funds from the CFBF went directly to the OEM to supply the equipment. And I was catching up with Daniel earlier, the CEO of First Electric, and he told me the equipments are already in the ports. So that's good news, and that's what we consider success, because it tells you what that capital can do. It's supposed to provide over 5,000 connections, small-scale businesses, like really micro, small-scale businesses that ordinarily won't have access to electricity. So in essence, what I'm saying is the climate finance blended facility gives not only long-term capital, but also aggregates capital from, pension funds. Today in Nigeria, the pension assets are about 23 trillion naira. That's less than shy over, $20 billion. And that tells you the amount of scale that you can do with that type of funding.
To sort of add to what Ojuru mentioned on the recently concluded First Electric transaction, it was about a 5,000 connection household, and it was the first mesh grid scale-up project we have here in Nigeria. And Ojuru mentioned something about the climate finance blending facility, but the other side is the institutional funding that the InfraCredit guarantee unlocks. For traditional pension fund administrators as well as insurance companies, they would rather invest in stocks or invest in bonds. They're not interested in infrastructure because they perceive that this is a very risky environment. But when you have a triple A rated institution like InfraCredit backing a transaction, what it does to them is that it reduces that perceived risks, and they're interested in funding and co-funding into that project. And that's one of the examples we've seen today. And thankfully, we are not stopping here. We are still trying to do even bigger connections. And as I speak, even on the same First Electric transaction, there are works on trying to scale to another 30,000 connections with the help of this same InfraCredit guaranteeing solution. So these are classic examples of how guarantee is helping to unlock both institutional funding as well as the concessional funding to make the interest rate cheaper and then scaling the project overall. Thanks.
Thank you. Toby, are there indeed, if you look at what you have done at the Shell Foundation, are there any other examples or real-life cases that you can discuss, that you've seen or that you've worked on?
Okay, thanks. So with guarantees, we've taken a more holistic approach to it and looked at the entire funding cycle. And the first thing is we looked at the asset suppliers, and when they approach financial institutions to get funding, because of what they are selling or because of the sector they play in, the way Naivasha and Co would look at them is different from someone that is selling maybe more traditional goods, right? So which means they carry the risks across board. So at some point we said, okay, let's help mobilize working capital, because if people like equity investors in the room are deploying equity and no one is supporting these companies with access to debt, then you're going to have a crush, right? Like something is going to happen in the industry and things are going to collapse. So we've entered into various guarantee agreements to aid the supply of working capital, some of which were done in Kenya, some in Nigeria. The Nigerian case is what we do with Sterling Bank, where we did a first loss guarantee in which the goal was to help Sterling Bank increase their confidence of deploy capital to these companies, while at the same time also reducing collateral requirements, because at the end of the day, financial institutions, because of the nascent stage of these companies, do not have an understanding of the sector very well. It's growing, we have to admit that. And so in some instances, they ask them to bring collaterals that are very huge. So we then had to say, those are kind of guarantee help increase or reduce the cash collateral that is required, and if possible, also reduce the physical collateral that is required. So we did that with in Sterling Bank in Nigeria. In Kenya, we worked with the cooperative bank, and the goal was using guarantees not just as a risk mitigation, but also as an interest rate step down, where we provided the guarantee, but we then figured out that affordability was also an issue, right? Because we are trying to serve a segment of the market that is probably below living income or just a little bit above it. And if interest rates are like average of 2% monthly, and you're doing 24%, that places a little bit of a burden. So we said, okay, instead of just deploying grant, let this be used as a guarantee vehicle for the banks. At the same time, reduction in pricing for the cooperatives, farmers who will be getting the asset. So in those two instances, it's been focused on the company and the consumer, right? In some other instances, we've structured guarantees to support fund structures or facilities. So similar to what InfraCredit is doing, where it's not a bank, but they need to help push capital into the sector. So there's a popular company called Nitio. So when they were trying to raise funds from commercial investors, we then provided a first tranche loss into that fund, which then enabled them to be able to raise capital from more commercially minded investors. So those are some of the instances where we've sort of like applied guarantee much more directly. Yeah.
I think that's super interesting, and I see you want to add to it, but, or?
No, I just wanted to add something on what you said, because it's very important. We are using guarantees in pricing, especially for SME clients. Number two is also in the assessment. We are now introducing a parameter where if the loan is covered by a guarantee for an SME, the risk profile of that SME automatically changes in the system so that the decision is quicker, because that particular facility is placed under the guarantee. And we have seen more utilization of guarantees, because the challenge that we have is you consume this guarantee, then you never utilize them. So introducing those parameters in this, you are actually monitoring how are they being deployed, becomes a key measure of performance of those guarantees for us as well. Just want to add on to what is.
No, thanks. Thank you for that addition as well. And I think what is very interesting is that I've heard you talk about, what guarantees can do on perceived risk, the real risk, really in the value chain. I love Toby. Thanks for also bringing it up to the holistic level, because I do also feel that guarantees can make quite a difference on the ecosystem level, right? If you talk about policy risks, you have already addressed, obviously, the currency risks. Anyone who wants to talk a bit more on an ecosystem level, how guarantees can help mitigate the risks?
Okay, I think I'll use a practical example. So the MD of REA was here earlier, and he talked around how, ecosystem, are you just creating, is it just forcing the developers to do productive use of energy, or, is it looking at it more like an ecosystem play? And I think at InfraCredit, we prefer the ecosystem play, because it then, catalyzes a lot of some cottage industries, but then industries that can blossom into bigger sectors. And I say that because we do have a huge pipeline of, transactions in the renewable energy space, particularly solar, over 500 billion, of just developers asking for funding. Now, what that has also done in the Nigerian market is also to catalyze local assembly, right? That's a new industry that existed in Nigeria prior. So all of that was bettered, yes, by policy changes, things that had originally been a struggle. Policy has changed and now has encouraged, new capital investments in the solar assembly or solar manufacturing in Nigeria. We've seen how the policy change has also strengthened, capacity of developers. So we're seeing that developers are evolving from just EPC to developers, but also to renewable energy service companies. So we've also seen how productive use is very catalytic. So you have productive use companies, people who just focus on productive use. They are not mini-grid developers, but they go to those rural communities to set up, provide processing equipment. There are lots of cassavas that are lost that can be processed into different, types of products. So I believe the energy space has the capacity to catalyze local economies and the larger ecosystem in Africa.
So it can actually be quite a powerful instrument if used correctly. I know you are also using guarantees. How do you see that?
First and foremost, I think I'd like to switch tact a bit and also talk about blended finance being used in complement to guarantees, because there's a bit of a difference there. So I'll give you, for example, what we look at in Camco. So in Camco, we have catalytic technical assistance facility, where we give developers who are at early stage funds structured as a reimbursable grant to essentially catalyze them and get them to a point where the project is shovel ready, and then we can now deploy funds for construction. So that's on one end on how to get projects to a bankable structure or phase. But now when it comes to also now guarantees before we actually now deploy the construction capital, it comes in to address a specific unbankable need that we have. And in more often than not, it tends to be to do with, issues around FX mismatch, or issues around payment delays from the off-taker, and that's where we also now rope into other sort of products that are out there in the market, and I must say there are quite a number. We have, for example, the ATD's Regional Liquidity Support Facility, which for countries that have actually signed up for this facility, it helps cover, let's say, any delays for off-takers up to, let's say, around 6 months worth of payables, which is really helpful for lenders to at least know that the payment is, covering this slippage, as opposed to, making sure that there's no non-payment or that sort of thing. So guarantees help in covering a specific risk, as opposed to, let's say, guaranteeing the entire, let's say, project, or removing the entire default risk, because this also helps in terms of the costing and the pricing for the end products. If you try and cover everything else, I think the cost will be too much for the project, and that in itself would be counterintuitive and make it unbankable.
Yeah, so that's interesting. So you do see guarantees as an instrument to basically bridge this bankability gap, right? But I liked what you said at the start of today's session. You said it's all nice and well, but it can never fix a bad project. Maybe can you talk a bit more about that? And I see you also wanted to react on on what was said before. I'll just pass you the mic. Oh, there's a mic there. And please.
Yeah, I just wanted to add on what Mwangi has said in terms of the blended finance and where guarantees sit within blended finance. And I will maybe give an actual case. I might not give the names, but this was a 10 megawatt project. No, a $10 million project. So it was structured. First of all, there was a first loss of about 15% that provided by GCF. Then you have a guarantee. World Bank, FDB, and others on political, on off-taker risk, and all that. Then you have KCB with the senior debt. Then we have down the equity contribution of about $1.4 million to the project. So when you do it that way and develop that capital stack that combines first loss, guarantees, private debt, and equity, you are able to de-risk those projects at scale and be able to implement that's a real case that we participated in terms of arranging that. Just I want to add when you talked about blended finance and where guarantees come in that space.
Yeah. So what I really like is also that the examples that you're given are the examples that are sometimes high level, sometimes very close by to what the developers need. So maybe Ajibola, you can also talk a bit more on, how much was your deal? How much was it demand driven? How much came from you? Did you have to do all the thinking, or was it really in cooperation? So also for the other developers here, like if they want to make use of this mechanism, what did it take for you to get there?
Yeah, thank you so much. I think you mentioned about collaboration, and I think that's pretty much important for most of these deals. And I want to think of it as in the aspects of how we integrate PUE into the systems. When we talk about PUE, what it does naturally, it actually first of all blows up the project cost. And from a developer perspective, they might feel like this is too expensive. I don't have enough grant to be used to repay these. But when you have guaranteeing instruments coming in and you're using that guarantee to unlock long-term local currency financing, so you're no longer looking at the PUE as this is a burden for me to incur this upfront cost, but you're looking at it from a perspective of this is an opportunity for me to make my project more bankable, ensure I'm having recurring revenue, because I'm not thinking about repaying this in the next 2 years, because what the guarantee is going to do for me is that it's going to help me to unlock a long-term local currency financing. For example, in this case with the InfraCredit, a 7-year local currency financing. So today we are, like I spoke earlier about a 30,000 connection pipeline. And I remember when we went to Lagos and have a meeting with the whole team, and they're like, what we want to see is we want to see more productive use embedded into these projects. And naturally, this probably will not be possible if you don't have guarantees that are helping you to reduce the cost of capital, because, like I said, the first thing is the upfront cost, and then you need to pay back your loans. But if your revenues are coming from some of these productive users that you've been able to install, and then you have more time, more leeway to boost the energy load, and that just gives you more comfort from a developer perspective that this is a good way to integrate PUE. So in a nutshell, putting it all together, I think one of the things the guarantee part can also fix is it help you to integrate PUE into your systems without thinking too much about how am I going to repay my debt, because now you have a long-term debt facility that is paid in your local currency.
You want to go ahead, Joa?
Yeah, so I'll say some of the other benefits that guarantees provide, I mean, just given the rigorous, process, is really around structure, the structure that the developers have in the room, in their operations, the sort of governance that they also have, right? A lot of these developers are one-man businesses, entrepreneurs, and you want to really see how they can evolve very quickly. But I think it's also the willingness of the developer to admit to what they don't have and what they have, right? Once that admission has been done, then the guarantor then looks at ways that they can support to enhance their capacity to scale. I think the other thing I would hammer on again is collaboration, how you work together with your guarantor or the guarantee company, bringing in, the type of people that will provide you the capital stack that you require. And the final thing I'll say is on standardization. And this may, take the room off a bit in a way, because sometimes the financier doesn't really know what exactly they want. So it's a bit difficult when you're talking to multiple lenders in the room, and then someone is saying, oh, I need to do this, or I need to do a financial due diligence, or, oh, I need ESG done, and they may not know what exactly they require. So I think it's very important as financiers to standardize the requirements, work with these developers. The lady from the first session said that, we need to stop making promises. We now need to, make these commitments real. So it's to work with the developers, but then standardize your requirements. Let it be clear that before you can be financed, these are the 5, 10, 15, or 20 things that are required. I think it will go a long way to help the developer. It would also save cost as well, and then save time.
Yes, thank you. And yes, please go ahead.
Yeah, just to add on that, and I forgot to answer one of your questions. When you asked about, guarantees don't turn bad projects into good projects, and what is required. I think from a financial perspective, project preparation is key for us. The technical aspect of the project, the commercial aspect of the project, the legal, regulatory aspect of the project, the financial model of that particular project, and even recently you've added community participation. We have seen some projects being stopped by communities, especially the ones that, mini grids and some PPA projects. So we cannot bypass those things because even we have a 100% guarantee for the project. So project preparation and we are even insisting, and because there are so many funds around for project preparation where you can get a grant, sometimes a returnable grant, for preparing that project to be bankable. Then guarantees just comes to risk other things like the political risks, the currency risks, the off-taker risks, and the other risks that we enumerated in the beginning. So that is in the context in which I said the guarantees will not turn bad projects into good projects from a banking perspective.
No, I think that's a great point, and it has to do also a lot with building market confidence. And I'll get back to that, but first I also want to make a little bridge. Ojuru, you were talking about indeed also about the smaller developers and so on, and I think everyone who was here this morning, I mean, one of the pledges that stand out was the pledge made by Camille from ANCA, or the vice president here of ARE, to not forget about the missing middle. And I can imagine that also now developers here in the audience, if you're not one of the bigger guys, that you wonder, okay, but will this ever also unlock more finance for me, and how will it help me and my part of the sector scale? And maybe Toby, I think you have some really good insights to share on how we can actually get there.
Yeah, thank you very much. So much more recently, we've started looking at the sector, and the question that is informing our thesis on how we deploy guarantee is comparing the sector vis-a-vis other traditional sector, because that's what the banks do. That's what each of the financiers on this stage probably does, right? And we then said, this is it. The missing middle, the guys living below the living income and all of that, the banks are not, they are going to be the least or the last set of people to be considered, because more often than not, if you put out a carbon finance fund today, it's probably going to go to a geothermal project, it's going to go to a wind project before anybody considers the solar lanterns in the village, right? Or something very, that costs less than $50 and $100, right? And then it then informed some of the decisions we were making. So we looked at it and said, who are those that are currently serving that segment of the market in adjacent sectors, right? It doesn't necessarily have to be people operating in the sector right now. And the most vivid example was a competitor to M-Pesa in Nigeria called MoneyPoint. So today, MoneyPoint has been able to bank a lot of people living below the living income, which is actually replicating the success that M-Pesa has had in Kenya. And then MoneyPoint currently does a lot of lending to people living below the living income. They finance them on several other things, but they don't finance them when it comes to renewable energy assets. Like they don't even think about it, because one, there's a lack of knowledge about the sector. Secondly, if 1,000 people walk into any bank branches in Nigeria or Kenya today, they probably will not fulfill the requirement to get a loan, or they're not well onboarded and all of that. But those smaller traditional financial institutions or MFIs are closer to them. And then we now said, okay, we spoke to the developers and we said, your biggest problem is that if there's no grant funding coming from the World Bank, from the REA or opportunistic scenarios, how well do you make organic sales, right? Because if you're unable to make organic sales and the banks are looking at you and are saying all of your sales is coming from grant-funded projects, it then influences the way in which the bank looks at you. Because what happens when the program stops a few years from now? Are you going to be back to ground zero, right? So we then said, okay, this is what we'll do. We're able to convince MoneyPoint to start doing renewable energy lending. But they were not going to be doing the lending and giving out cash. So what we're doing is trying to onboard multiple PUA asset suppliers who sell different products to be onboarded on the MoneyPoint platform. Then, because this PU asset provider have a good understanding of the customer base and they are able to work well with them, anytime they need a product, there are two sales channels. Existing partners can always get products and they get introduced to MoneyPoint. MoneyPoint customers can always acquire this asset directly. Now, there are two sides to the level of influence. On the side of MoneyPoint, we're then saying, because this is a very new sector to you, we're going to be providing a guarantee to you up to a certain percentage, so that in comparison to other assets that you have today, where you have minimal understanding, at what rate does this cover it? So we covered it on that side. Now, the unintended consequence of this is, or the hoped intended consequence of this, is that MoneyPoint is not in a position to finance the PUA asset suppliers adequately. That's still an area where you still have the banks. Now, if the bank picks up the book of one of the asset suppliers 2 years from now and looks at it and says, your sales are more organic than it is from random grant-funded projects, we can then give you a loan. So essentially, we're beginning to use guarantee as a market creation tool where we hope to activate demand organically and then help the PU asset suppliers serve the customer segments in which they probably are best suitable to serve, while also increasing the confidence of the bank and other financial institutions to then really come into the sector with less apprehension. Yeah.
Yes, thanks for that. And I see indeed that it adds up to basically a lot of bringing back confidence in the sector, right? I think all of us have seen financiers and investors leave the sector. If I listen to all of you, you're here to try and find solutions that will really bridge this decline in market confidence. It also builds on what you said, Eric, because you should be aware that a guarantee is not fixing a bad project, because the moment you do that, you're using the guarantee mechanism that gives us the possibility to reinforce confidence back into the sector, and then if you're using it for bad projects, you're actually exactly doing the opposite. So it's really about bringing back the confidence, but Abiodun, I'm really very interested in hearing from you as the only developer here on stage. You have been building and creating your company without the type of solutions that Toby has mentioned. I mean, you're now fortunately working with InfraCredit, but how do you see the examples that are given here on stage would have helped you or can help the sector and your colleagues in the audience?
All right, thank you so much. I think the good thing about the guarantee is before now, there wasn't a lot of people who have heard about mesh grids. People were like, what does this mean? What does it entail? But after the announcement with InfraCredit about guaranteeing a mesh grid transaction, we've seen beyond the lower interest rate, institutional funding, I think it's brought this sort of signal to the market that this is another asset class that can be financed. So we are seeing like different financiers reaching out, trying to understand the technology better and seeing how they can finance it. For instance, we are seeing people from the crowdfunding, even on the crowdfunding platforms, trying to do financing for mesh grid. We are seeing even For instance, we're speaking to some people and they're like, even cryptocurrency guys, they're looking at, okay, we saw this news and want to be able to learn more about this technology and be able to finance it. So I think the good thing that it has done is, and what you have seen, what everybody is saying is, as guaranteeing is helping to, unlock financing from different segments. There is the part that has to do with the end users, where you spoke about money points. Because of the guarantee that they have now, they are able to finance end users. We are seeing how that is helping, like climate energy funds, where they're able to attract institutional investors. We're seeing now that they're using guarantee to back a new asset class. So it's just clear how guarantee itself, it sends a signal to everybody, and people are then keen to know more about, okay, how can I tap into it? There are a lot of people now benefiting from it. A couple of years ago, probably just have one institution doing guarantee, but now you're having several institutions trying to provide guarantee to unlock different part of the ecosystem. So it's a good signal that we are having, and we need to keep up with that pace.
Yeah, thanks. And I have a question to basically Eric, Patrick, and Ojuru. Because you've also talked about blended finance, and often we see that when there's a financing transaction, you're not the only financier in a deal, right? It's a lot in partnerships and cooperation with others. Do you feel that the way you're using guarantees is actually helping other financiers to do a specific deal, to stay in the sector, or to come back? Or is there anything that you see happening there to make us happy?
Okay, I would say for guarantees in general, not the, well, maybe yes, the renewable energy space. So there's a project that InfraCredit financed or guaranteed that gave them access to finance in 2018. It's the Ojuru Hydro Dam in Niger State in Nigeria. So the first time they accessed funding was through InfraCredit. So we provided the guarantee that enabled them raise capital from the pension industry. Now that helped because it was able to, repair some of the damage that had happened to the plants. So that plant had that terrain, they have large crocodiles, and culturally you don't quite have divers locally in Nigeria. I don't know about other African countries, but we don't have divers who are bold enough to dive in where they know that there are crocodiles. And the crocodiles had snatched off some portion of the intake gate for that hydro dam. So it meant that that needed to be replaced, and the government didn't know what was wrong. But InfraCredit coming in, we did studies to understand what was wrong, what was required to replace, those damaged parts, and those things were replaced. They brought in divers, by the way, so we didn't have African divers, but neither did we have Nigerian divers. So yes, the experts came in and did what they needed to do, and now that plant is working. They went back to the market again to raise funding without InfraCredit's guarantee. So that tells you what the guarantee can do, the power of the guarantee. They first came to the market, they were not known, they had InfraCredit's rating. So the instrument carried InfraCredit's rating, which is AAA, by the way, and they got funding. By the next time they were coming into the market, they've shown track record, they've shown that this plant can actually work. It was just an unfortunate situation that the animals got happy. But then they had to do other things to protect that asset and ensure that that asset worked. Now that asset has capacity to black start the capital of Nigeria. So that gave investors confidence, seeing the performance of that asset and what the guarantee can do. So yes, guarantees do have the potential to unlock, not just access to finance, but then allows first-time issuers go to the market, get money, and then allow them to come back again without a guarantee. So it does boost market confidence.
I'd like to maybe give an example of maybe what we've done at Camco, and a recent example that maybe can help demonstrate how a guarantee has really changed perception and improved, appetite, I'd say, for lenders and investors to develop projects in Africa. So I think it's a specific example. I can speak a bit more now about it because the project has now reached financial close. But this is a project that was in Zambia, and it's an IPP, and the off-taker, as we all know, ZESCO, has had some challenges in the past. I don't want to speak too much about it. You never know, I might be a diplomat in my next career, so I'll try to keep it as kosher as possible. But nonetheless, we managed to be involved in this transaction whereby it's the first non-recourse project financed construction project which does not have any sovereign guarantee in place. So how that happened is Garantco actually gave a guarantee to the developer and also backed the funding that comes from the off-taker, who in this case is a power trader, so it's somebody in the private market. So this is quite new for Africa. We are used to having an off-taker who is tied to the state, and we need certain guarantees from the state. So this was a unique way of unlocking capital, whereby the power is now sold into the South African power pool. And I'm sure that will unlock more and more projects going forward because of this guarantee that has been put in place.
Yes, please go, Eric.
Yeah, I don't know how the imported divers were de-risked from the crocodiles, but I can give an example of de-risking a project where there is no track record. Because banks we look at between 5 to 7 years track record. You find most of these developers don't have that track record. So one of the instruments we have used is what we call the warehousing lines, where you work with a DFI and they provide guaranteed lines, say for the first 20 to 30 megawatts at portfolio level. When that is proven and you can see cash flows, then I refinance and unlock that capital now for the next project, and the guarantees naturally now fall off. So that's the warehousing, using the warehousing lines. I think that has worked for circumstances where you can see it's a good project, but there's no track record. Essentially, you're substituting the track record of the developer with the track record of IFC, of AFDB, of DFC, who have 60 years combined of AAA rating and all that. So we have used that to de-risk projects that look good, but the bank is worried about track record.
Yeah, interesting. And I see you nodding as well, Toby. This indeed is building of market confidence, and is that something that you've experienced in Shell as well?
Yeah, so at the end of the day, nobody provides a guarantee and hopes to continue in perpetuality to continue to provide it, right? Except you're dealing with a large capital project that covers up like 30 years, 20 years, and all of that. And we've seen some demonstrable success from some of our fund-of-fund investment or support, where providing a guarantee has then triggered a second-level effect in the ecosystem. So I'll take the example of NITIO had a facility called the FAIR facility, where we provided guarantee into the facility. They went on to raise funding, and beyond raising funding, they then were able to deploy that funding to various companies in the ecosystem. Now, if you look at it, you'll have seen NITIO as a financier, right? And you'll have thought, oh, they don't have a problem raising funding. But for every investor in this space that tries to raise funding for renewable energy, they are competing with the same pool of funding, that are going to other more established sector or flashy sector like transport, technology, ICT, where the multiples are probably surer, or there's an established bankability, and the framework is just easier. So in that hand, NITU has been able to raise, excess of like $10 million, fund several companies within the ecosystem, and then you're seeing it from a perspective of funder to asset supplier. Similarly, there's the example of SeedB in India, which is an equivalent of like a development bank of India. And what we did for them was, there was a lot of MFIs that needed to get funding to finance renewable energy assets. And SeedB, being very up there, upstream and all of that, could not come down to do this, and they didn't understand the sector well. So what our guarantee did was providing some form of assurance for them to lend to the sector, to those microfinance institutions, who then were able to deploy capital to the sector much more efficiently. And in like 3-4 years, in the last 5 years rather, we've moved from normal solar energy system products to more sophisticated or commercial assets like 3-wheelers and even 2-wheelers and all of that. And as at the last time I checked, that was already a facility that's disbursed more than 200 million. So somehow, but we've been reducing the influence or guarantee percentage over time, because the bank has also gotten more confidence to lend to the sector, because they're beginning to see it as more traditional. So the summary here is guarantees they're not an unending tool, because if you use it as that, it's a very bad thing, but it's a confidence booster and a more market creation tool at the end of the day. Yeah.
Well, I wish that would have been the last words of this panel, because there's no way we can beat that. It's very positive, and it really, really underlines the strength of the instrument, and not just in theory, but that we actually do see it happen on the ground, the catalytic and the impact effects of if you use it correctly, indeed. I had a question for you, Abiodun, because if you look at what's been said around you, it feels like once you have this deal with InfraCredit and have their kind of stamp of approval, that brings you more than just the actual deal. Is that true in reality as well?
Yeah, that's absolutely true. And so, like we said over time on this panel, that guarantees are catalytic in nature, they're enablers, they send signals to the market, and this is just evident in, for example, all of the examples that Tobiloba has mentioned, the ones that Ojuru has mentioned, and the other people on the panel has mentioned. So we are seeing the effect, like I mentioned earlier. We are seeing more people, for example, from the developer side, understanding, coming to ask us more about, okay, MeshGrid, let's see how we can do a couple of projects. We see that InfraCredit has backed you guys, and so it's just creating that confidence. Like the cost of marketing has reduced, like the amount of money you would have spent to get new customers, it's been reduced because there's that word there, that word of mouth there, that people have been able to like promote your technology. So it's significant for us, and I think I don't know what else to say there, but it's been really good for us, and we are now seeing a lot more connections in our pipeline, a lot more developers trying to do MeshGrid. So thanks to that first transaction that we've been able to do with InfraCredit.
Thanks for that. Just to manage expectations a bit, because I know we started 15 minutes later, I do want to take a few more moments and not also open it up for 1 or 2 questions from the audience before asking all of the panelists some famous last words before we go to the drinks. So I don't know if there's anyone here who has a question in general or for anyone specific in the panel. You can just stand up. I see at least two, yeah. Is there a mic? There is a mic coming your way, yeah.
I think I've got a loud enough voice. There we go. Yeah, hi. Thank you very, very much for the great panel. I think guarantees are becoming quite a good instrument and mechanism in order to, for the market creation, what was clearly mentioned. I think one of the things that were never talked about on the panel is when you look at your probability of default for the guarantees versus the actual defaults. Can you tell us a little bit about that, whether you are experiencing more defaults or you feel like you are within your risk thresholds for those guarantees?
That's a very interesting question. Who is wanting to open up their box of secrets on this? Eric, do you?
Yeah, I have two answers to that question. The first one is on the pricing of the guarantee itself. I know that that is not what you have asked, but allow me to start there. Because when I consume a guarantee instrument and I do my mathematics around pricing of that guarantee, and I go to my portfolio and start calculating how much would I lose if a default materializes. I've seen some guarantees that are more expensive than what I would lose in my portfolio if that default crystallizes. So that's the first one. And that's always the rule of the thumb when I'm consuming a de-risking instrument. The second one is, are we seeing defaults from these guaranteed portfolios? The answer is yes, and sometimes no. And yes is a good answer because that's why you consumed that guarantee in the first place. If you thought that you can't lose anything in that portfolio, then why do you consume the guarantee? So it's yes, and it's a good thing. And actually, we are measuring that out of how much are we called the guarantee. So it's a parameter for assessment of guarantee utilization. How many times have we called that guarantee on a portfolio? So that then we start understanding what are the issues, what are the risk factors, because guarantees are supposed to help us take more risk and learn from it. So the answer is yes, we are seeing defaults. In other cases, we are realizing we didn't even need a default anyway, or didn't a guarantee anyway, but that's also a learning because it gives confidence for me to deploy that capital.
I see Ojuru, you want to?
Yeah, so on the Nigerian side, on our particular portfolio, we haven't seen any defaults yet. Yes, surprising. And I think it's because, you can clap, that's fine. So, thank you. So I think it's really largely the grants, the DES grant. So we first had the Nigerian Electrification Program, and then we now have the DES, the World Bank, grant. So the performance-based grant adds to the capital stack. So that's how we treat it. So perhaps why we're not seeing all of that. But then that's for the renewable side. On our main portfolio too, we've just only seen snags where, maybe there's been port delays, so the project timelines have had to extend, but not necessarily, the lack of cash flows within these projects, because we do take some time and, we do a lot of drilling to get information from the clients, and we do our due diligence to be sure that those projects are actually viable on the large, big-ticket infrastructure side. And then for the one we did with the state government, there's an irrevocable standing payment that comes directly from the state government's federally allocated revenue. So that also helps, to prevent any shortfalls in, cash flows from the project.
Thank you. Thanks for the great question. And there was one more here.
Thank you.
I see you have follow-up questions, but you can do that after the session directly with them. Oh, you were saying thank you. Perfect. Please go ahead.
All right. Thank you, and I'd like to say thank you to the panel for the exchange, the quality of the exchange. I come from Burundi, and it's quite a unique place that needs guarantees for projects, right? So I was wondering, the same way we are here at AIF, and we invited all the stakeholders, is it possible to look at it, blended package, in a new way, addressing the issues on the ground? There's MEGA, there's others, but they're at a certain size, right? And how about a programmatic approach, like we all know it, but go the extra length to actually take the time and discuss mechanisms or providers of mechanisms that are at a certain level, a certain ticket size, to try and really impact at a mass level? Because so many are left in between the ones that can provide and the ones that really need it on a mass scale. Thank you.
Thank you for that question. And I think, Toby, that was a lot on what you also tried to address earlier. So maybe you want to take it first, and then I can ask anyone else.
Okay, this is a difficult one because I share your opinion, and my view of the sector is that the sector is too split in such a way that everybody's trying to solve different problems in bits. Unfortunately, the bits do not always add up. You either have some concentration at the top, and then the people who are focused on serving the micro market, the really micro market, are unable to reach it efficiently. But I think what we've been trying to do at Shell Foundation, although not more of a country stance, is to consolidate this effort much more appropriately, right? And in the past, we've tried to look at financial advisory as a way of structuring products that are very, very sector unique and also niche unique. Because I feel like one of the gaps that has existed in the market so far is that we have tried and we still continue to borrow from other sectors that are not very similar to the sector, right? And we need to do a lot of financial engineering where, and hypothetically speaking right now, where you set up a really, really big mega fund. And this mega fund is not just deploying to a top business. The incentives for the mega fund to deploy guarantees, equity, debt, to also businesses that are serving or initiatives that are serving like bottom of the pyramid is also there. Because for every, just like Naivasha mentioned earlier, he said when he wants to look at the guarantee, he then goes back to his portfolio and says, what's the cost of this? Because at the end of the day, every capital provider here has people that they report to, has people that have given them those funds. They're just a custodian, right? And then when they lose it, no matter how much guarantee you give them, even if you give them 100% guarantee, there's an alternative use of that capital at that point in time, right? And they probably would not even consider it because it could invest in treasury bills, it could invest in several other things. And then you also now have instances where we've structured guarantees and the banks have not been able to deploy, right? And you're like, this is supposed to incentivize you to deploy. Then we then figure out that the problem is that guarantee is a tool, but probably we did not structure the guarantee the right way, right? So, which is calling for more financial engineering or building specific products that sits down with every type of financial provider and says, why are you not lending to this sector beyond the fact that it's not profitable? What's it that we can do to eliminate that risk on your side? Is it that we give you longer guarantees, or we insure, we do some form of price insurance? We need to really sit down and design products that are market specific and capture the economic realities of the segments in which we're trying to address this challenge for. Thank you.
Thank you, because it also means that despite all the good work that we are already doing and seeing, there is still a lot that needs to be done, right? We're not there, even with all the things that we have been sharing here today. There is still gaps to be bridged, but we do realize that guarantees can be part of the total solution. I think there's no time for more questions, but if anyone has a question, we're all here, and after this we're going to the drinks, and the drinks is always a good moment to find any one of those people here and to ask your questions. And we are actually going to try to give you a little gift for those drinks, because people will ask you, how was your day, what have you learned? So they'll all give you a takeaway from the guarantees, and that you can use to boost your knowledge. And at the drink, say how much you've learned. So each of them has like a very short last takeaway, and feel free to share that, because we think that there's a lot of people who are very interested in learning more about guarantees, and it would be great if this session today has helped you to talk about it with others. So I hope you can give them something to be proud of during the drinks.
It's an interesting conundrum. It's a very serious topic, and then you're mentioning drinks. So I think the best I can say is guarantees is like a, makeup for a lady, helps beautify things, but really doesn't change who she is internally and the beauty around it. It doesn't cover the fundamentals. It doesn't, so it helps, but it's not the entire solution. I think that's the best way I can summarize.
Yeah, I have a similar one to Patrick, because this is where we started. And we said that guarantees don't make bad projects good. So project preparation is always key. And then the guarantee comes to make that project look better on a bank spreadsheet. So that's what they do. So we cannot substitute good project preparation. And I think the last one for me is, and what I've seen is, if you put $1 in guarantee, you can actually leverage $5 to $6 of private capital, for scale. Thank you.
So my final words, I think, will be to the gentleman from Burundi. If you're focusing more on energy access, perhaps speak to First Electric and Okra. First Electric is the same project that my colleague here was talking about. It has potential to give you access to electricity whilst understanding the peculiarities by being boots on the ground. And I think my parting words would be for financiers to first standardize the requirements. 2 would be hampering on project preparation and project development. And then the third thing would be around the productive use and ecosystem building.
I hope you're taking notes, right? Because you're telling a lot. Please go. Yeah.
Okay, my final word will be to maybe developers that are seeking to raise financing for the first time, to remind you that guarantees are ways for you to leverage institutional funding, and it gives signal to other financiers such that even in the future, after your first guarantee project, you necessarily don't need another guarantee because now you're known in the market. So take advantage of these guarantees, use it to raise your first capital, and then move on from there and raise more capital. So that's what I'm going to say. Use the guarantees, they are available.
Yeah, thanks. My final word is this, and I'm going to take in the side of the financiers this time, is always have it at the back of your mind that the financiers have a huge incentive to deploy capital. No one enjoys keeping capital and not financing anything. So if you have any solution that you're proposing, sit down and ask myself, would I finance this? Which is one, and you would know why you probably should not finance it. And then ask yourself, moved towards the solution set and said, how can I ensure that the bank gets to finance this if I was a banker? And then you can throw ideas up, because I'm still of the belief that we've not found the best solutions yet. The sector is still evolving, and we need new radical ideas that can ensure that financiers are more comfortable deploying capital within their acceptable risk threshold. And it also, a word of note to all of us that also do financing, is that we need to work together more. Like I mentioned earlier, there are too many random pockets of people doing different things, and it's not just coming together, which we need to stop. We need to work together more, because that's the only way we can reduce our exposure, eliminate the risks, probably not eliminate, but reduce it significantly, and also achieve great success. Those are my words.
Well, thank you. Thank you all for that, but also for this last words of really working together, because that's key for this topic. It's key for, I think, the sector, and it's one of the main reasons why we've all come to this event and this forum. So thanks for this. I do want to ask for a big round of applause for my panelists. And we hope to see you all around the pool area near the waterfalls. Oh, and I see you in 10 minutes? In 10 minutes. So look forward to seeing you all there, and feel free to come to any of the panelists if you have more questions. Thank you.